So this is a joint project with Alan and Andrew, both who are giving me the privilege of being here today, and Argyris, who used to be a postdoc here at SURF and who is now back in the States. So essentially, this presentation is going to be a little different from the previous ones because it's going to be kind of light on actual results from research questions, but it's going to be heavy on constructing this special data set that I'm going to about to tell you. And there's been quite a big stream of literature in finance that tries to look at what is the impact of individual decisions on financial markets, whether it's the market risk premium and so on. But one of the main drawbacks that this literature has is that it's very difficult for us to have a comprehensive and high frequency data set. And by high frequency here, I mean anything more frequent than monthly or quarterly data of what people actually do. And that's essentially the main purpose of our grant that the Keynes Fund has generously given to us. So we have obtained through the Brazilian Stock Exchange this awesome data set in which we have the initial holdings data of all investors in Brazil, whether it's a corporation, a mutual fund, an individual. So we have a picture of their portfolio holdings and every single transaction that they placed over the next 2 years, okay, which is something that really goes beyond anything that we believe we have in the literature at the moment, apart from one paper, one data set from India that I'll talk in a while. And so as I show you this data, I'm going to tell you afterwards what are we planning to do with it, what we hope to learn, and what are the next steps. Okay, so in a nutshell, as I said, we have more than 550,000 unique investors. And the interesting thing in Brazil is that B3 not only is the only stock exchange in the country, but they're also the only custodians of data. So everything that takes place in Brazil goes through this data set. So if, for example, we have a company issuing new shares, it's going to be represented there. If they do a buyback, we're going to know. If it's transactions, say, between sovereign wealth fund from Saudi Arabia buying something in Brazil, we're going to have that as well. So what they have provided to us so far is a snapshot of the portfolio holdings in December of 2011. Then they have given us this 48 million trades for the next 2 years. And if any new investor shows up and enters the market, we are there. So you can imagine that we can take a look at not only new assets entering, but also well, the beginning of trade of certain investors. Okay, as in most countries, even though retail investors comprise the largest majority, so 95%, they correspond to only 16% of trading volume. And this data set includes really stocks, ETFs, options, so much more than we believe anything at the moment is in there. Of course, because this information is highly confidential, they didn't give us the tax ID number of every single one of them, so they randomize it, but at least you have some basic investor data. So we know their types, whether they are retail, mutual fund, or foreign investors. Okay, and one of the biggest challenges of the data set is essentially one, computing power. Remember that for every single of these 550,000 investors over the 550 trading days over these 2 years, that already gives us about 278 million portfolios. So every day for every person, we know what they have. And on top of this, remember that a portfolio can have and often will have more than one stock. So if each one of these 280 million portfolios have, say, 10 stocks, this would be about 2.8 billion observations. So to process all of this, we are buying some computing time from Cambridge's high power cluster. Okay. Not only this gives us a safe storage for data, you can imagine that the NDA that we have to sign in order to get this data from Brazil, and also how to use, I think we're doing things in Python or R that can handle all of this. So if these starting ideas that I'm going to show you in a second actually start working, we are very optimistic that the exchange might even provide us more data. So they seem to be willing to extend and recompute the data to move from 2013 and hopefully end by 2018 and 19, allowing us to even look at the beginning of COVID, depending on what happens, but definitely a lot more in terms of prices and what happened in markets. Now, the next thing that I want to show you is essentially the descriptive statistics. And we kind of took a while to do this because when we started working on the data set, we pretty much identified an error in the data that they sent us. And we kind of unfortunately lost almost 4 or 5 months until they corrected the data and sent it to us, which is the main reason why, as I mentioned, I'm going to be light on actual results, but heavy on the data set. But just to give you an idea, so this is from where the 95% of the market coming from retail investors is. So notice that here, on average, the median retail investor in Brazil owns a portfolio of about £7,000. Okay, so back in 2011, the exchange rate between the Brazilian currency and the dollar was 2 to 1. Right now, unfortunately, well, maybe luckily for me here in the UK, is about 5.45 to 1. So I feel 3 times richer when I go back home. But notice that if we look, say, at mutual funds and foreign investors, the median is much higher. I mean, on average, is about 4 million. Notice that we have some mutual funds that they have a portfolio close to $100 billion. We also have corporations that own $420 billion. And those numbers are big and they seem big because we really have, for example, situations like Santander, so the bank in Spain, owning shares in the Brazilian subsidiary. So this would show up there as Santander being a foreign entity owning those shares, and we see it. Okay, and this can happen with family firms. The Brazilian oil company is actually the 3rd or 4th most traded stock in the US through their ADRs. And again, these American depositary receipts essentially comprise what? The sponsoring bank buys the shares in Brazil, keeps that in their portfolio, and issues a receipt in the US that allow people to buy and trade, which again is behind some of these big numbers. We also have information on things such as the investments of NGOs. In Brazil, we have very large state-owned companies that they can own a lot, pension funds, so all of this. The international investors, they come from about 66 different countries, most frequently coming from the US, followed by the UK, but we have people from all over the world buying things in Brazil. So the next data set essentially shows the proportion of the market across different investor types. And here's where I want to highlight something interesting. If you believe, say, the CAPM or the basic asset pricing models, they say, for example, is that if the whole Brazilian market is comprised of, say, 18% of foreign investors, we would expect that those investors should essentially allocate money across stocks in the same proportion. Okay, and as you can see from the graph here on the right, that's exactly not what happens. So it shows something that we already know, that many investors are active, so they try to deviate their portfolios from the standard market as a way to make money. But for sure, this has implications about the returns and the market impact of those investors out there. The next slide essentially shows the number of stocks in the portfolio broken down by investor type. So a couple of interesting things. Notice that most individuals only own one stock. This doesn't necessarily mean that they are under-diversified, because this stock might be an exchange-traded fund, right? They might invest in an ETF that gives them exposure to the Brazilian market, for example, which again, is something that we're going to explore. Notice that as we would expect, foreign and mutual funds would be sophisticated investors that probably would hold more assets. That's kind of what we observe here. A big chunk of the mutual funds, I think more than 60%, have more than five different securities in their portfolios. And then I start showing you just some breakdowns in terms of what happens. So for mutual funds, 17% only hold one asset, 7% two, and 3.5 3. And that's kind of the distribution of their values over time. So it seems relatively normal rather than with over-distribution. So for foreign investors, a similar thing. I mean, as you can see, most of them are not that diversified, and we're going to break this down to understand exactly what this one asset that they hold actually means, whether it's a basket of stocks through an ETF or whether it's really investing in one particular company. Okay, and this is the same thing for the individuals, which seems to be way less diversified than the other ones. The next slide is just to give you the context. So this is a graph with the Brazilian stock market index between 2008 and 2018. So notice that since the financial crisis, the index is kind of flat. After 2008, it kept going up, but our sample period is a period in which Brazil was actually going down. It was when we had those protests kind of in between the World Cup and the Olympic Games, when all those nasty protests were going on in Brazil and the market had been tanking. Okay. The next one, focus on the most traded and largest stock in Brazil, which is by Petrobras, our oil company. And this here shows that about 40% of all investors in Brazil hold Petrobras, so 200,000. And this graph shows the distribution by how many shares they own. So this first big spike here shows that about 15,800 investors own exactly 100 shares in Petrobras. So notice then we have about 14,000 owning 200 and about 1,000 owning 6,000. So the scale here is in logs. So the log of 100 is going to be closer to, I guess, 5. And that's what we have it in here. Now, another thing that I want to show you is that 4 different companies. So I don't know if you remember, but there was a time that in Brazil we had this gentleman called Eike Batista, that he became for a brief period of time, I think the richest person in the world or the second richest person in the world. And he had this conglomerate of companies, so called the X Group. So M, I think it's based on mining. He was trying to set up a bunch of different, a little bit like the Brazilian version of Elon Musk, but with lots and lots of traditional investments. But then he over-levered, and when Brazil started going down, as you can see, his companies really tanked. I mean, I think he spent a little bit of time in jail and he lost everything. But the point is, at some point, all of the stocks comprise about 30% of the Brazilian market. And even though all this decrease in share prices took place, and they were big enough that we would expect, according to theory, that if we have major changes in the value of some stocks in your portfolio, you should rebalance, right? You should alter your allocation to reflect these changes in value. And one of the things that we have been finding in the data is that investors don't trade as often as they should. Okay, we know some results show that investors trade too much, but there are lots and lots of investors in the market that they are not trading at all. That's one of the directions that we're going to explore over time using events like this. So the last slide before I shut up is to finally talk about what we're doing with such a rich data set. And this first bullet point here wasn't included at all in our proposal because this paper by Javier Gabay and Ralph Kodjian didn't exist at the time. So for those of you, I think in the finance literature, maybe Lynn and Wade will back me up here, there has been quite a lot of interest in this paper that is about this inelastic market hypothesis. So the idea that Ralph and Javier are doing is essentially, well, if an investor, say, sells $1 of bonds and comes to the market and invests in $1 of stocks, what actually happens? So what is the price elasticity of demand in the aggregate stock market? Most models show that it's really small, essentially that the demand curve for stocks is flat. But what this inelastic market hypothesis proposes is that essentially inflows and outflows can have a big impact. And using this granular IV technique, they show that $1 extra entering stock markets will increase the aggregate value by 5. So prices will go up a lot. And they're trying to convince everyone that a lot of the random movements in the market can actually be explained by these inflows and outflows from the asset class. When they do this, they're using data available to all of us normally, traditionally, that is only at the quarterly frequency. So you can imagine the amount of reactions and shocks that we lose by not having the type of data that we do. And we're kind of pivoting and thinking about writing the first paper on the data on this simply because of the traction that this paper has gotten. We think that with our data, we can really see what is the impact of these flows. Since we really have everyone in the market, we can confidently show that how much money has entered into the Brazilian stock market in a given day in a particular stock, unlike anyone else. So we can come up with much better estimates of elasticity than anyone before. And this on its own is already interesting. On top of this, the other research questions is, one, there's this paper on the AER by Xian and co-authors, in which they exactly talk about how the rebalancing of portfolios by investors, or maybe the lack of it, is related to the volatility of the market risk premium. In the sense that if I'm the only person adjusting my portfolio to news, I will be bearing risk and I would demand compensation for this risk relative to those that don't do anything. And we can actually test this hypothesis, again, taking advantage of this high frequency data to do so. The next two are essentially, I guess, more traditional ones. But, well, how do investors react to new information? And because we have, again, this daily series of all stocks in Brazil for every individual, rather than just a subset, which is very common in the academic literature, how do investors react to this? Do large investors or sophisticated investors react faster? Because we have everyone, we are trying to see if we can do something, say, with the network of investors, and so on. So hopefully, in this helicopter view, I have convinced you and showed to you why we really are excited about this, that we really believe that we can develop a long pipeline of papers, because the data set is really unlike everything in the world, apart from one. So there's a paper from this year by John Campbell and Tarun from Oxford, in which they had access to data from India, okay? And, but at least now, his current paper has nothing to do with this type of stuff that we're doing at the moment. They're focusing on something else. But in a way, the Brazilian market is a lot more sophisticated than India. I mean, there's much more money. Just to give you an idea, the Brazilian mutual fund industry is as big as the one here in the UK. So hopefully, because it's more sophisticated, it's going to be closer to the effects that we would expect in the US and in Europe than the Indian data. But in short, this is a great data set. We're hoping that we'll be able to expand it. We're going a little bit crazy, cleaning up the data, making sure that the cluster is useful, but that's what we do. Thank you so much, and talk back to you, I guess.